Good morning, good afternoon and good evening. I am Emma Joyce, Head of Community at Global Digital Finance, and it's my pleasure to welcome you to the Global Leaders Town Hall in partnership with the Global Blockchain Business Council with special guest Tarek El Diwany today. Throughout this series over the coming months, we will be hosting weekly sessions with policymakers and business leaders to hear their insights into the emerging COVID-19 crisis and field questions from members of the community. Abdul Haseeb Basit, board member and treasurer at GDF, is hosting today's town hall from London, which is focused on the role of debt in the financial system and the implications that creates in a time of economic shock as we are currently experiencing. Abdul is also a co-founder and principal of Ellipsis, a research advisory and venture builder, chairman of Yielders, a crowdfunding property investment platform, and the regulated Islamic fintech in the UK. Previously, Abdul was CFO of Innovate Finance, the UK not-for-profit FinTech Members Association, and also worked in Tier 1 banks in technology transformation and strategy with a private wealth and asset management focus. Tarek El Diwany is a director at Queertok Zest, a research and advisory company which specializes in financial product development, real estate investment, Islamic finance, financial publishing, and financial training. Previously, Tarek was responsible for the European bond derivatives market at Talit Prebon and went on to establish the firm's Islamic finance department, advising on the structuring of finance for clients in the Middle East, Europe, and Southeast Asia. Tarek is the author of The Problem with Interest, a work on monetary economics now available in 4 language editions. He has lectured professionally in the field of finance for several academic and commercial clients. Throughout his career, Tarek has been a pioneer. He helped develop the Western world's first commercially implemented debt-free home financing scheme with Ansar Finance and Lovells Law Firm in 2006. Tarek is a long-time advocate of monetary reform and commodity money systems. He has advised on matters of monetary policy in several countries and has appeared alongside well-known economic reformers in documentary films including The Four Horsemen and Memi Wars. Tarek is an occasional commentator on economic and financial matters for major global media outlets, including BBC Television and Radio. Today, we welcome and encourage your questions. If you do have a question, please feel free to submit them at any time using the questions box located at the bottom left of your screen. We will anonymize your question when we pose it to Tarek. I hope you enjoyed today's session, and I'd now like to welcome Abdul and Tarek.
Good morning, good afternoon, good evening to everyone listening today, wherever you are in the world. I hope you and your families are staying safe and well during this period. I'm really delighted to welcome Tarek El Diwany to our Global Leaders webinar series, jointly hosted by Global Digital Finance and the Global Blockchain Business Council. As Emma said, you'll be able to submit questions throughout this session and we'll address those towards the end. But first, Tarek, for those in our audience that haven't come across your work before, could I please ask you to give a sense of your background and how this led to the books that you've written and to the work that you do today?
Yes, thank you very much. Well, and thank you for inviting me. I have been working now in financial consulting for perhaps 25 years or so on my own as a consultant in my own practice. I've had experience in project finance and derivatives in what you might call real-world finance as well as market finance. And really, although I'm not an economist per se or a lawyer or an accountant even, I've gathered views that I've come across and experiences that I've had to put together my views that I want to talk about today. So I don't know whether you want me just to go straight into those ideas and those concepts, or whether you want to ask me a few more questions first, but I'm happy to go if you are.
Perhaps I can put a bit of frame around it and sort of talk about how I first encountered your work. It was primarily during the financial crisis of 2007 and 2008, through a documentary that you produced called Why We're All in Debt, which I believe is still available on YouTube for anyone to watch, and I highly recommend it. And this, for me, was the lead-in to thinking around sustainable, ethical, and Islamic finance in my career. And since then, in your writings, your documentary appearances, your news appearances, you've unpicked much of the financial system that exists today in I think, a very unique way. And that's why I'm really pleased that you're able to talk to our audience today. I think, firstly, you take a historic view to understand the origins of money and banking and delve specifically into the role of debt and interest-based debt in the financial system, which I hadn't seen anyone do before, and the externalities that this creates, whether they're understood or not. You interestingly also point to a number of examples in history where the unsustainable nature of the system is laid bare, for example, through financial crises, and where previously attempts were made to rein some of this activity in. Historically, this was in religious societies that took a moral and ethical stand against some of these underlying practices. And there's relevance today to more secular societies who are now grappling with some of the same issues. And lastly, I think you frame a very compelling economic argument as to why these systems persist, and some of the incentives baked in, whether it's with the theory of trickle-down economics, money creation, the role of debt, the fractional reserve system, and even the use, from an accounting perspective, of discounted cash flow, all of which, in summary, leads to sort of short-term profit-seeking at the expense of real economy, and creating long-term sustainability within the economy. And so, once again, we now find ourselves in a crisis. The current crisis has been defined as as different to the previous crises, as this is a healthcare crisis that's leading to a financial and economic crisis. It is nonetheless a financial crisis. And in the first of our webinar series, we heard from the City of London Sheriff and Alderman Michael Manelli about the financial system, and how it's been found wanting at a time like this again, and what opportunities exist for new approaches to emerge and to take hold. So with your background and your perspective, I'd like to invite you to give us your view of the current crisis, how the systemic issues you've described have led to what we're experiencing now, and how they can exacerbate some of the problems.
Yeah, well, thank you very much. So really, I was given an orthodox education, I think, in economics and finance. I was one of Thatcher's children, really. I went into the city in the mid to late 80s. And I think the first time that I really began to question the system was when there was a Live Aid conference and show in Wembley, and various talks going on around that with Bob Geldof in 1985, I think it was. And they were trying to raise money for Africa for debt relief. There was a famine. They wanted to help the starving kids in Africa, and that was fine. And they managed to raise $50 million, and there was a big celebration, over that whole event there in London. And it was only a few years later that I actually realised that 50 million that they raised came back to the Western lenders within 24 hours, because that's the average daily interest charge on African debt. And so I began really to think about, let's say, relative proportions in the world. There are a lot of big numbers around, but what are the relative proportions of things? And if you ask about relative proportions, then that can help in many things. I mean, it can help in understanding the COVID crisis and mortality, for example. But in economics, it's very easy to lose sight of what's important and what isn't so important if you don't understand relative proportions. And I've heard economists and politicians many times talking in a way that indicates that they've actually missed a few zeros off their off their concepts, if you like. So eventually, after a few years working in derivatives, I decided that something that attracted me a lot was Islamic finance. And I wanted to go in and work in that business because I genuinely believed, and I still do, that the central premise is that if you're going to finance business, the fairest and the best way to do that is to share profits in an equity-type relationship. If you, as a financier, want to take profit when your client is losing, if you want to bankrupt your client and foreclose on his assets and take them to get a return on your capital when he hasn't made one, then that seemed fundamentally unfair to me. Whereas if you want to do finance on the basis that you win if your client, so that the user of funds, wins, then that seemed fundamentally fair. It's quite easy to see this once you've had a career in finance. If I look at the sort of end users who receive finance, they're typically the ones who have the most collateral, because banks want to secure their lending. And that means that the people who get financing in the system we're in, the interest-based debt system that we're in, are typically those who are already rich. And if you're poor and you don't have collateral, you don't get finance. Whereas with equity, what tends to happen is that if you've got a good idea, you get financed. The amount of collateral you have doesn't actually matter so much. It's your management skills, it's your idea, it's your IP. And that creates a fundamentally different type of economy, less white elephants in my view, less wealth inequality. The poor guy has as much a chance of raising capital as the rich guy, because what counts is the idea, not the existing wealth. And so those kinds of ideas attracted me to Islamic finance, and I, at one stage in my life, put together a little slide which you can see here, which tries to identify the difference between creating wealth and transferring wealth. And it's my premise, and many others, I think, in the economics profession believe that a society that doesn't create wealth in the long run dies. Clothes wear out, machines wear out, houses and buildings fall down. You need to create wealth to maintain these things. You need to create wealth to implement scientific discoveries and move the world forward. And if we simply rely on processes in the economy that transfer wealth, for example, theft, then in the long run we're not going to get anywhere, although some people will make a lot of profit in the meantime from wealth transfer processes. That doesn't mean that all wealth transfer processes are bad for the economy. Clearly some are very good. If you look in London, the history of orphanages, of schools, of hospitals here, you'll still see the blue plaques on the wall which say that this hospital was funded by an endowment in the 16th century, or this school was funded by an endowment in the 19th century. So there's clearly gifts, endowments have taken society a lot further than it could have done on a purely commercial basis, and yet a gift is a pure transfer of wealth. The one who gives doesn't get anything in return. So I've shown that little chart there of why people might do wealth transfer and why they might do wealth creation and how. And I've said some things are done for profit and some are not for profit. And generally, what I'm arguing here is that if you see a society which focuses on wealth transfer for the sake of profit, then that society is in trouble. If that is the predominant process. And gambling is another form. Usury, I would argue, is one, because why should you get a return on capital if the capital has not yielded any use to the one who uses it? And of course, there is this final point that I'd make on Islamic finance. There's a long history of Islamic finance, actually. If you lent money at 5% interest in London in 1600 or 1500, you would have been guilty of a criminal offence, and the same outside of the Christian world in Jewish law too. So there's an issue here, and it's kind of been swept under the carpet for several hundred years, and we're having to kind of rediscover it. There are occasional attempts to rediscover why traditionally, for thousands of years in fact, going back to prehistory, as far as we can tell, lending money at interest was regarded as something that was very destructive. And so, I would argue today that, even though interest rates may be small, we're not going to get ourselves out of severe problems. We're not certainly going to get ourselves out of a debt crisis by lending yet more. I'll give one example for those people who are in finance here of the effect that the interest-based system is having. And I've asked a very simple question, that you've got a farmer who has a choice. He can farm his land in a very intensive way or in a sustainable way, the way that his forefathers have been farming, and he can make a profit of 100 a year, forever, basically. That's what his father and grandfather and great-grandparents have been doing on this plot of land, and they sustainably yield 100 of profit a year. Or he can go for highly intensive farming and yield 150 of profit a year, but only for 15 years, after which the land becomes desertified. Now, if you face that choice as an environmentalist, a biologist, an engineer, any kind of non-financier, you would think it's madness to go for the high yield option. And yet, if you apply an interest rate of 10%, discounted cash flow analysis tells you to go for the high yield option. It tells you to turn land into desert for the sake of more profit today, and that simply cannot be right. And I would argue that any tool which tells you to do that has something seriously wrong with it. So coming back from that, if we look at the world today and we see how predominant one kind of financial mode of operation is, then we should perhaps, I mean, I would go as far, and people often recoil from this a little bit, but I tell you, I think the plastic in the sea and the global warming is partly, and perhaps largely, due to our financial system. And you're just beginning to hear whispers about this. Maybe the growth that we have is forced upon us by our financial system. The effort to repay debt, maybe, is something that forces companies and economies to grow. And then I ask the question, what if we can't repay our debt? So I'm looking, let me just flip back here. I'm going to move on now to the monetary system and how this relates to the way we do finance, because again, we have a relatively new monetary system. The one that we have now is perhaps 300 years old. And it hasn't been this way. We've had commodity money for the vast majority of humanity's existence. There have been some exceptions, the Chinese, for example, in the 10th century, 11th century. But this one that we have now is the exception. And we have largely had a commodity money system through history. Now, let's just look at this for 5 minutes. If you imagine the early bank taking a deposit of £100 of gold coins and issuing receipts, paper receipts for £100, those receipts were initially looked upon and should be looked upon as depository receipts, receipts saying, I'm holding £100 worth of gold coins for you in my vault. Come and get them whenever you want, and here's the evidence of your ownership. I, the bank, am a trustee holding on trust your gold. Right? Now, people, of course, began to use paper receipts as money. They didn't bother to go to the bank to get the gold and go and do their shopping. They just spent the paper receipts because the shopkeeper knew he too could spend them to pay for his supplies or his rent or whatever. So those receipts begin to circulate, and then the banks realize that they can actually change their business model and become lenders of money. And when they lend money, what they do is that they print new receipts. They don't lend gold. They only have 100 of gold, but they can print new receipts ad infinitum. And they do that because they can lend receipts at interest, effectively. So it's no surprise that the banking model that we have, in which banks actually create out of nothing the money that we have, became much more established as the prohibition of interest was repealed and relieved in the Western world. Now, the problem here, of course, is that the banker has created 500 legal claims of ownership on the same 100 of gold coins. You can't tell the difference between the 400 receipts and the 100. They all look the same. So, there's a word for it when you create 500 legal titles on 100 things. And I would argue that banking is therefore fraudulent in nature. And again, that's a very big statement, and people recoil from it because they may not understand what a bank actually does. I mean, we have to have payment transmission services for sure, and safe custody and advice and M&A. I've got nothing against that, but if say a house builder created 5 legal titles for the same house, the housing market would be in chaos. But this is money, and it affects everything, you see, so it's fundamental. And this money is injected at interest, so it's multiplying if you like, the damage that interest causes. So we'll move on a little bit. I've got some slides which I guess people can download later, but this is a subject which is well known in many areas. I mean, there's even a Federal Reserve executive here, talking about the fact, in his view, and this is almost 100 years ago, that our civilization may collapse unless we understand the defects of that system. There are other ways, and we're beginning to talk about them now. Why should, for example, the state borrow money from the banking sector at interest. If the banks are simply going to print the money out of nothing, why doesn't the state print its own money and borrow it interest-free? And this is an example of what happened in the United Kingdom. The British government, to finance the First World War, actually printed its own money. This is a treasury note. You can see it doesn't have the words Bank of England anywhere on it. And it's a very strong argument, and now is being considered at very high levels. Obviously, we may be doing it in a way that's not well recognised, but when central banks buy debt directly from government at interest rates of close to zero, then they are effectively issuing interest-free money. So why don't we have interest-free money? There's a good question there. We have a case in history, and this is the last historical point. When Abraham Lincoln came, he was very much in favour of state money, and laws were in fact passed to increase and encourage the increase in the usage of state money as opposed to bank money. But of course there's a very strong lobby out there, and look what the lobby does. The lobby is writing from the American Bankers Association to its members across the United States, telling them not to support newspapers which are in favour of state money because it will affect the banking system's profits. I mean, it's quite I think this is very, very seriously undermining. It's clearly putting profit before the benefit of society, in my view. So then a few, issues now that we are going to have to face again. Here is, if you pump new money into a particular market, here's the housing market. If you lend lots of new money into it, house prices go up. So you have to look at where the lending is targeted and what it's targeting, and here lending for house purchase and house prices in the UK, very strong correlation, which is revealed by this chart, the rate of change of those slopes, the first derivative. If we look at the change in lending against the change in house price, it's a very strong correlation. It's actually, for those of you who like to trade, it's slightly predictive. And if you can find any asset class where the lending, you have early access to the data, you have a slight advantage, actually, in predicting the asset price movement. Some economic consequences which we don't talk about too much, but are plainly evident in my view. Here is a shopping mall, which I often show this photograph in my presentations, and I was with my kids just waiting for them to sort of run around and get tired, and I'm looking at this view in a shopping mall here in England, and I realised that of the 11 shops that you can just about see in this photograph, 9 are owned by the same company. They've got different trading names for sure, but they're owned by the same group. The group has leveraged itself by borrowing newly created money at interest, at an interest rate which is lower than its return on assets, and by borrowing it manages to buy up the smaller companies and create a large group. It's effectively the monopolization of business, which leads to this sort of, this is, I don't know, it's masquerading as a free market, but it certainly is not a free market, and yet we assume we have free markets in the Western world. And this monopolization and loss of variety, you can see it in many areas. You can see it in clone towns, all lookalike towns, lookalike high streets, housing which is very anonymous, and lookalike housing. 3 or 4 large companies dominating many of the main business sectors. And again, we have to question, is that the kind of world we want, the leveraged world financed by interest-based debt on a leverage principle with newly created money? That's where it goes. And a couple more, just because I want just to give people a flavour of this. This is France. This is the way they built a suburb in France, and it's in the 18th century in a place called Arras, the beginning of the end of the 18th century, beginning of the 19th. And again, I was on holiday here, looking around, and it's beautiful. You want to sit there and have your sandwiches and all that. You can see the skill, the quality. And the reason I'm showing this is that if you look at a suburb the way they built it in the 21st century, you only have to walk 500 yards to the right, and you find this. And I don't know whether I have to say anything, but to me, those 2 pictures speak volumes about the way that our world has changed. I mean, for me, the purpose here has not been maximizing profit. I mean, they could have used cheaper materials. They could have done it more quickly. They could have done it with smaller units, but they didn't. I believe their object, to a certain degree, to a greater degree than we have today, was to put wealth into their community, whereas the object here is to pull the wealth out as quickly as possible. And I think you can see it. And then maybe if you can't, well, keep looking maybe. Houses built of corrugated plastic in London. The street one down from this is Victorian workers' cottages built of stone and brick. They have 50% greater room volume. We have the smallest houses in Europe and England. But to build out of corrugated plastic, and we're supposed to be richer than the Victorians were, right? One final point, apart from equity financing being a greater proportion of our finance, and apart from having state-issued money or a commodity money maybe, or at least an interest-free money supply, how would we finance houses? I mean, it's all right for a VC capitalist to put equity into, a Silicon Valley, he can share the profits, but how would you share the profits of a house buyer? How does society do that in a largely equity system? And I'm showing this as an example that we can do that. Here is a partnership between the home buyer and the finance company. They own a house as partners, 80-20 in this example. There's no debt. If there's a crash in the housing market and values go to zero, then the finance company owns 80% at zero. So no repossession, no negative equity. In the meantime, the home buyer, who's owning 20%, becomes the tenant and lives in the property if they want to, and if they don't, then they put it on the market and take 20% of the rent net for themselves. And over time, they can buy out the finance company when they want to. Now, again, there are just new products in the last 3 or 4 years coming forward which are beginning to look at this kind of issue. They're coming from non-banks largely. And, again, they're facing a challenge, because if you don't have the ability to create money from nothing, you need larger margins, basically. But there are people who are talking about, how we can bring into sectors such as home finance a greater degree of partnership and risk sharing. And I honestly believe that, whether or not you agree, and these points may be very challenging for some people, I understand that, but one way or the other, we have to get a greater connection between the source of finance and the user of finance, because if their interests are aligned, then the provider of finance wants the business to survive, because his only way of getting out of his position is for that business to survive and recover. And that race to foreclosure that I've seen so often in my life between bankers with a failing business, that won't happen so much. I mean, I guess it will to some extent still, but not so much. And I think I'll leave it there, because I guess there's time for questions too.
And so, I do have a few more questions. We've got some questions coming in from folks on the webcast, and I encourage you to send more questions in. So you've talked about sort of this race to foreclosure, and ultimately what we're seeing now is when the economy is moving towards almost a dead stop economy, we can't really foreclose on that many things, because there is no part of the economy that's fully functional. And so as we're looking at this current situation, what do you expect some of the implications of some of the policy measures to be? So we're seeing a lot of quantitative easing, increased lending, pandemic bombs as a concept, although it's questionable whether they've been actually successful. Helicopter money being dropped straight into parts of the economy where businesses and people need it the most, almost circumventing the financial sector. But essentially, it's sort of the same old tools. It's sort of debasing the currency and increasing lending. And with your narrative, that's in the long run, that's not necessarily going to be taking us in a new direction. It's sort of sticking a band-aid on a gaping wound. And so, what do you expect the implications of the measures being taken right now to be?
Well, at a simple level, if money supply is expanded dramatically, as it is being currently, and production falls, then there's only one way that prices go, and that is inflation. Much more money chasing far fewer goods. I suspect that in 12 to 18 months we'll see the result of that, as we have in every previous rescue. You can see this in asset markets after 2001, after 2008. We've a very substantial boom in many asset markets, even after very serious events, and it goes well back. But it may be the case that the new money is withdrawn somehow. They're finding it difficult even now to withdraw the money that they created in the central bank level after the 2008 crisis. You'll see that the central bank balance sheets, I should say, are still, swollen from where they were. They didn't go back to the levels of M0 base money that were existing in 2006, nowhere near. So they haven't managed to withdraw that new money, and I guess the same will be the case here. And if productivity doesn't pick up and production doesn't pick up, then we may have a serious inflation problem. It could reignite consumer price inflation, but certainly I think asset price inflation will have to go up. And that's quite obvious really from a fund management point of view. If you're sitting on cash and 300 billion is being created in the UK, a 10%, 15, 20% increase in money supply in a few months. As a fund manager, you're not going to sit on cash. You're going to put it into equities, property, and you're going to choose your time. So to an extent, I think, it depends what you think of the virus. If the virus is something which comes back every year and takes 2 or 3% of the population, then everything changes. But if it's something like a 1% mortality, well, it's terrible, of course, and very sad for many people. We have 1% mortality every year anyway, and 1% isn't going to change the world of economics, and we'll be back, so I think, this isn't just a monetary issue, of course it isn't, and people's behaviours may change, there may be a sort of awakening of, spirituality, but I wouldn't bet on it.
Well, so moving to sort of acting differently, and I can see some of the questions coming in. Interestingly, in the past, had we been talking about this, there may have been some sort of challenge to the way you're describing economics. I think largely from the looks of some of the questions, the audience is sort of moved beyond that and is now looking forward. And so you've been an advocate for a very long time of alternative approaches such as 100% fractional reserve systems, asset-backed currencies. You've even tried asset-backed currencies yourselves in the past. A number of firms within both the GDF and the GBBC community are working on asset-backed tokens. Where the prevalence of sort of central bank issued digital currencies is sort of coming to the fore as well. And I've heard you describe the sort of debasement of currency as almost the lead indicator for the decline of a society or a civilization. And so, as we are looking for new approaches, where would you like to see us go from here as we come out of the crisis? What are the opportunities for those of us that are currently in financial services to think and act differently?
Well, I used to think that I could change the world, give a few good talks, meet somebody powerful, and everything would be okay. But, I think there are two things here. There's a bottom-up work, which everybody is welcome and has a duty to some extent if they're in the right position to engage in bottom-up work, speaking to your friends, your family, your community, people at work, trying to do the right thing on an individual scale. And you're seeing that has some effects in ethical finance now. The 20s and 30-year-olds are, their views and demands are beginning to change the way some fund managers operate, and it's changing the dialectic. And so I think that in the long run, the people have to be informed and they have to act according to their knowledge, and hopefully they'll inform themselves correctly. We also have to bear in mind that there is a lobby, there are vested interests, and there's two ways that these things are surmounted, if you like, and one historically has been that they're wiped away in a war or by a pestilence, and another is that a force of argument comes, and over quite some time, probably many decades, things change. So I myself do not believe that the cause of a problem can be its solution. So, I do not expect commercial banks to be our saviours in this process here. I would like, as somebody is suggesting here, that instead of bashing away at this yet more debt solution, that the government does try to set up some kind of equity funding for businesses, that it does try to provide a basic income for all. It was at least 100 years now since it was being argued that technology would bring a much easier lifestyle for people because machines would do all the production. Well, we've gone well past that stage, and yet still people are having to scrape around for a living. Why can't we have some kind of basic income, or some arrangement which provides for people in that way? So, there are other ways than lending money to people and businesses that will get money into circulation. Debt write-offs is another way, but that doesn't take away the systemic causes of the problem. They will eventually come back. So, I think we have the tools if we want them. We already have the tools, and we have a legal framework which will support those tools if we want to implement them. But we have to recognise that there are lobbies out there who don't want us to implement them. And I really don't think that an industry which, I remember Stiglitz was writing about the banking sector in the States in 2006 was taking 30% of all corporate profit. I do not expect them just to throw up their hands and walk away from that. So we have to be clever in the way that we organise ourselves and the sort of partners that we seek. And I think funds, I think partnerships, I think charitable institutions, they all have a role to play in that solution.
Thank you very much, Tarek. I'm going to turn to the audience questions. We've got a few that have come in on some of the themes you've touched on. So I'm going to run through a few of those. And please do keep your questions coming in on the webcast. So there are 2 or 3 areas we start to see price inflation. Are there 2 or 3 areas we will start to see price inflation in the COVID-19 crisis, such as food supply chain? Do you think there's any particular ones that we can look out for in terms of price inflation right now?
I don't know. I wouldn't like to hazard a guess. I mean, anecdotally, you can see that the grocery sector is, making up for lost time here, I suppose that's to be expected. This is partly an attitude issue, but partly, when you're living in a system that is filled with insecurity, this is the kind of thing that happens. That the people who are insecure try to make as much as they can in the short run, and that insecurity there. Again, I relate that partly to the indebtedness situation. If you're in debt, that weighs over you, and it weighs over your decisions and your attitude. But as to who is going to profit on this, I know the doctors have been telling me likewise in healthcare that there are some really heinous examples of profiteering on PPE equipment, for example. I don't know whether this is just, a one-off or whether it's, something which is common. But I wouldn't like, what I would say is that if, from an investment point of view, if you're looking at companies, basic industries, for example, in essential chemicals, in essential materials, you can't set up a refinery in 6 months. You can't set up a chemical plant in 6 months. It takes years. And you have large companies which are in monopoly situations, or quasi-monopolies in many cases, and their stock price has fallen 60%. And for myself, looking at that, I wonder what some traders are they betting for the end of the world? Because if they are, they're not going to be around to pick up the winnings, So, I feel that the areas I expect some inflation in the equity market, I think, the probability, the substantial probability is that the buying opportunity is there.
So you mentioned sort of government taking equity positions. This is a theme that's sort of coming up in the startup world and specifically in the UK fintech community. It's been touted as one of the options to support some early stage businesses. Conversely, what we've seen in the US is that the likes of airplane manufacturers like Boeing, who were seeking bailouts, and airlines that were seeking government bailouts, were told that they may have to give up an equity position in order to secure that, and politely declined. And what's really interesting is that, this sector has been sort of roundly accused in the press, the financial press, of having spent the last decade using their profits to buy back stock to inflate their share price. And now they're in a position where a balance sheet reserve may have certainly helped them at a time like this. And so, is it more likely that the government, or is it more actionable for the government to do that with SMEs and early stage businesses rather than some of the bigger leading businesses?
Yeah, I mean, I think it's the smaller businesses that have missed out on the share of the pie over the years, in the sense that the small businesses didn't tend to get the big bailouts last time round, and if one wants to have dignity in this, then financing small and medium-sized enterprises who don't have large collateral to offer is something which the state should support more, in my view. It's very different. You only have to be a small businessman trying to raise equity from the existing institutions to see how difficult it is and how little of it there is. And a major expansion there could be through the form of support for the private sector, or from the state directly. But of course, the trouble is there are trade rules, international trade rules, preventing state assistance to industry, and one has to navigate that. But if you're a state and you want to do something quickly, then you have to have the ability to do that, and then you need the levers in your hands, so to speak. And if you have nationalised the bank or nationalised the fund as a state operator, then of course that gives you a much quicker route through. And I do believe that if governments were more closely connected to the banking sector right now in many Western countries, they'd be able to act much more quickly. We're having a great deal of difficulty getting money out to stricken businesses now in the UK. The Germans are having fewer problems because they've had this very close relationship between banks, companies and government over many decades now. And although I don't agree with the banking model generally, that has produced a much more benign and a much more supportive environment for small and middle-sized enterprises. And you need to see the German Mittelstand, as they call it, the middle-sized business, how active and thriving and successful they are, to see that, the benefits of that.
And so, unsurprisingly, we've got a couple of questions about cryptocurrency and Bitcoin in particular, and so I'm going to read these out and sort of touch on the theme of these. So you've been an advocate for gold as a form of sound money, but the world does not seem convinced to return to a gold standard or any sort of asset-backed standard. Do you believe Bitcoin has the characteristics of gold and could become a viable replacement, parallel currency to fiat currency? And does it act as an offer a hedge against fiat as a safe harbour asset class? I mean, we've certainly not seen that in this crisis with the price fluctuations in Bitcoin and digital assets, that it isn't necessarily a hedge or a safe harbour. But what's your view on that?
Well, look, you have to decide which metric you're using here. If you say to me there is a currency which you can use and all of your transactions will be tracked and your funds can be frozen in a few seconds by diktat from somewhere overseas or at home, versus one which is anonymous and can be used as you wish without being tracked and cannot be frozen, then which would you choose? Of course, I'd choose the latter. There are distinct advantages to using Bitcoin over modern bank money based on fiat money. However, if you ask me that an asset class, what I say at the moment is that a record of an asset is not an asset. If we have a database recording assets which I own, to say that database is the asset, I have a fundamental problem with. I have it in the same sense that I have a fundamental problem with fiat money and bank money, in the sense that both are merely digital entries. At the end of the day, no one can take away a gold coin in the back of my pocket. And historically, we have several thousand years of evidence as to its purchasing power remaining stable. Now, that doesn't mean that I wouldn't choose Bitcoin over fiat money, and I can well see the advantages that it has, and that's where I'm going to leave it right now. I do believe token money, if you tokenized an asset, I believe that is something as a direction that we can go in, because you are, at the end of the day, clearly backed by a physical world asset. And, whether it's taxi rides in New York or gold itself or land or whatever it might be, a warehouse full of commodities or, then, as a kind of securitized asset base, it does what, one of the things that you want money to do, which is to achieve a kind of homogeneity, by splitting up a large pool of assets into individual identical securities, effectively. So, as a token, I think there are places we can go, but, how are we going to get that to be trusted in the long term? You've got a huge battle to do that. Then who controls the system? How do we know that there isn't a back door into the system? We've got to overcome all of those issues.
So two other sort of themes have popped up here. Firstly, on universal basic income as a temporary or short-term solution. What's your views on what's being done now with, I guess, in either direct or indirect ways? So, for example, in the US, $1,200 being directly helicoptered into individuals. In the UK through various business furlough schemes, where income is being supported. What's your view, and what's the role as we return to some sort of normality for UBI?
Yeah, I believe that the injection of money rather than debt into the economy is what we need right now as a palliative. If we're going to have a basic income for all, we have to think very carefully about how we implement that so that it doesn't disincentivize people from working. But compared to the increasing indebtedness that's being proposed now, if I'm given the choice now in the circumstance that we are in, my proposal has been for a long time to inject new money directly into the economy, into those hands that need it most, not into the speculating classes, but into the ordinary private citizen. It can be done through tax cuts, it can be done through direct grants, so that the money actually gets to where it needs to go and doesn't go through an investment route. And at the same time that happens, one has to reintroduce a reserve ratio on the banks that is increased by a sufficient percentage to absorb those new amounts of M0 that are injected, and that way you don't get a subsequent boom in the wider monetary aggregates. So, if the government spends 100 billion of M0 now directly into the private sector, and banks are operating a 5% reserve ratio, then that means we have 20 times 100 billion coming into circulation later in the form of new bank lending, and we don't want that. So we have to increase the reserve ratios of the banking sector over time to exactly, or more or less exactly, compensate for any new amounts of money that are injected into the economy.
You mentioned something earlier, which you touch on in your writing, in your documentaries quite a bit, which is debt jubilees as a form of debt forgiveness during times when debt reaches unsustainable levels. And I think we can argue that we're more indebted as a global population than we've ever been at this time, and we've already started seeing through this crisis a little bit of sort of debt jubilee with, for example, here in the UK, a number of NHS trusts were forgiven about 13 billion of government debt only a couple of weeks ago. And so, do you think? I know you mentioned that it's not a long-term solution, but do you think there's a role for further debt forgiveness at this time?
Yeah, I mean, again, as a palliative, yes, but I don't, it can easily become a way of sustaining the old system. You see, that's the trouble. And if you look at the way that, debt relief Jubilee was handled and what's resulted from that, we still have bigger indebtedness now, in fact, in the third world. And that's, after all that hullabaloo about the Jubilee debt relief, all it has done is to sustain the existing system in which, third world countries get paid peanuts for their commodities and can't pay their way into a dignified economic survival. Yeah, and that's what we need to create. You see, so this is why I'm saying that good intentions can be co-opted by the existing system. But if you're looking at it now, my view is that a lot of these debts have been accumulated through corrupt means, and you can say that even in the Western world. I mean, I've seen, PFI hospitals being loaded up with obscene amounts of debt purely because of profiteering by, banks on very high interest rates and contractors on very high profit margins. And I remember one of the doctors was telling me in London that they had to, they wanted to repaint a small room in their hospital. It was only a few years ago, and they had to, because of the PFI contract, they had to ask the main contractor to send a man around to, not to paint the room, but to quote for painting the room. And they got an invoice for the quote of £5,000. And just to quote, not to paint the room, the cost of the man coming to quote was £5,000. And when you're saddled with a PFI contract like that, and the health service generally is, then tens of billions of every, spending 10 billion more, if it just goes into this black hole of contractor profit margins and bankers' interest, then spending isn't the solution, right? So what I'm trying to say is that we have to look at this from several directions. Finance is not the only thing. Attitudes are a large part of the problem. Money supply isn't the only thing. There are lots of issues here that we need, power politics, geopolitics, resource mobilization. There's lots of things that have come together, and it's very difficult just to give simple answers. I'm hesitating a lot of the time because I've spoken with people who are involved in the health service and in Africa and in commodities and in politics, and it's always a very nuanced question, about cryptocurrency isn't going to answer everything. I've met cryptocurrency enthusiasts who think it is, it will answer many things, maybe, but so the world is complicated, and, I'm afraid I don't have any very simple answers, but I think on principle, the way I like to work is to say, look, there are certain things that if you do these, they are very destructive, right? And I do believe interest-based finance is one of them, and I do believe that fraud is another. And I think if you say, to people, look, there are certain basic things that we're going to implement here, or rather stop people from doing, and then you can do anything else and you'll be okay. I really actually think that the solution to our problems is to stop doing the really harmful things, and then we wouldn't need to think too much about advanced solutions. We're often, trying to solve problems which don't need to exist, and they exist because we have allowed something to happen in our institutional framework or in our system that produces an unanswerable problem.
So we're coming close to the end of our time. I'll ask a final question that's come in on the webcast, and apologies to those who we didn't get a chance to answer today. As we move forward, how do we unlearn these old methods and encourage people to use these more equitable forms of finance that you're describing?
Yeah, talk to people about it. I have sat in front of people in Canary Wharf, and I've gone through the discounted cash flow example, and they've never seen it before. They've never thought about it before. They don't know that banks create money. They think it's absurd. But if you plant a seed, the truth will win, I believe. And this is not some truth based on religion. This is just a mathematical example that anyone can do with a spreadsheet. And if someone's got a conscience, I think they're going to have to look at that and find some kind of answer for themselves. How is it really true, first of all, that the way we do finance can turn land into desert? And if it is, then what do they think we should do? right? I think generally, many people I meet in finance, I think, want to do the right thing, but they've just never been shown, the sort of collection of ideas or concepts which all gel together. And that's why I said at the beginning, I'm not a specialist really. Well, perhaps I am in Islamic finance, but I think it's very difficult in the world we're in to be generally knowledgeable about several fields, because that's just not the way that employment and careers works now. You have to know a lot about very little. But we need to sort of become more polymathic, and know at least something about these major building blocks on which our system works. And that, I think, helps.
Thank you very much, Tarek. It's been great to listen to you and your insights. Always a pleasure. I'd also like to thank the GDF and GBBC teams for their arrangement of the Global Leaders webinar series. And finally, thank you to all our audience for listening and for your participation and questions today. We look forward to welcoming you back for our next webinar, which will be hosted by the Global Blockchain Business Council, and it's going to take place on Tuesday, the 21st of April, with special guest Stacey Warden, Executive Director of the Milken Institute. Thank you very much, everybody, and goodbye.